Good afternoon, everyone. Thank you for joining us today. I am Valerie Arnold, head of our intermediary distribution at Pzena Investment Management. I'm here with my colleague, John Flynn. John has been with Pzena Investment Management for over a dozen years, and he is focused on portfolio management of our U.S. small, mid, and large cap value strategies. Today, we will focus our attention on U.S. mid-cap value, where we have been managing assets since 1998. John will briefly review our investment process and our mid-cap value strategy. And now let me turn it over to John.
Thank you, Valerie, and thank you all for joining us this afternoon. I thought it'd be good to start with a brief overview of how we approach our investing philosophy and how we implement our strategy. Those of you familiar with Pzena will know that we use the same process across all our strategies. And what we're really looking to do at the end of the day is to construct a portfolio of undervalued names for good businesses. The challenge is that typically to get something at a cheap price, something has gone wrong. And so we have a systematic process, a manufacturing process, if you will, for research that we implement over and over to identify these names, do the research, and get the names into the portfolio. And so what you see before you are the typical characteristics of an investment for us. The first two are quantitative in nature, the next three qualitative. And taking the first two, you'll see low price to normal earnings level. The main focus of our valuation framework is normalized earnings. And the way you should think about that is a year 5 mid-cycle cash EPS number. We will only buy stocks that are in the cheapest 20% on a price to normalized earnings basis. So a stock has to be in that cheapest quintile to go into the portfolio. Second point here, current earnings below historical norms, that's the problem. Typically, a company's chugging along, earnings are steady, something happens, earnings collapse, and that's where it comes up on our screens. We have quantitative screens to look at both of these, but where we really focus our time is on the next three issues on the page. One is the problem is temporary and not permanent. Typically, when we're looking at a situation, the belief is that things have permanently been impaired. And so we do a lot of work to get comfortable that things will recover. Second point here is that the business is good. A lot of times, value investors get knocked for buying mediocre businesses at very low multiples. We set to buy good businesses, which we define as a company that earns its cost of capital over a business cycle. We recognize that business cycles can be longer in nature, don't fall neatly into quarters and years, but over the full business cycle, we expect that companies will earn their cost of capital. The last piece here is that we look for significant downside protection. The first line of defense against this is obviously valuation by focusing on the cheapest 20%. But there's other things we'll look at, such as balance sheet strength. We're very adverse to leverage in our analysis. We also will look at things like hidden assets on the balance sheet, some of the parts analysis, everything to get comfortable that if we're wrong with our thesis, we don't want to lose that much money. And when we're correct, we want to make a lot of money. And when you create a portfolio of skewed outcomes like this, what you get is over the long term is outperformance. In terms of how we go about identifying these opportunities and getting them into the portfolio, what you see here is kind of a quick overview of the process. We start with a quantitative screen of the cheapest quintile based on price to normalized earnings. Based on that screen, we then assign the names that look interesting out to analysts. Our analysts are organized by industry, and so analysts will get a list of names to look at which point they're given the task of doing what we call a 2-week review or an initial review. The goal of this review is to answer 3 basic questions. One is, what does this company do? How does it work? What's the business model? How does it make money? The second question is, what happened? Why is the stock cheap? What's the issue? What's the controversy around the stock? And the third question is, what do we have to believe in order to get comfortable making this investment? Our goal at this point is not to get all of the answers out in the open and get all the data out there. It's more to identify the key issues that we need to research. Once an analyst has done that, they bring it into research review, which is a meeting we have twice a week, where all the portfolio managers on the product sit around. We have 3 portfolio managers on our mid-cap value strategy. And we discuss the company, the issues, make sure that everything is identified. And at that point, if we think it's still interesting and worth doing further work on, we'll move forward towards a full review. If we don't, we'll kick it out. And we kick out about 70% of the names at this point in the process, such that our time is focused on the most promising opportunities. If we do go forward with the process, we end up building out a detailed financial model, going through industry resources, going through any other relevant data to help flush out the issues we've identified, whether it be industry experts, competitors. Following that, we go and we visit with management on site. We like to sit down with senior management once we've got a fully baked investment thesis to really audit our thesis and make sure that our understanding of the business is in line with management's understanding and that management has a plan to fix the issues that are at hand. During this process, we're also seeking out the bear thesis, making sure we understand what others think and why they may be negative on the stock. Once we've done all this work and pulled it back together, we get back in the room to discuss the stock and really finalize our normal earnings estimate. At this point, if the stock is still in the cheapest quintile, it's a candidate to go into the portfolio. Portfolio construction is really an output of that process. If a stock is in the cheapest quintile, the cheaper it is on price to normalized earnings, the larger a position it's going to be in the portfolio. We also take into account things like sector or regional diversification and range of outcomes when putting the portfolio together. But first and foremost, the key driver is going to be valuation. Similar to our buy discipline, where we're only buying the cheapest 20% of the universe, we're also very disciplined about our selling. We sell a stock when it reaches the midpoint of the universe on price to normalized earnings basis. You get there two ways. The good way, that stock price goes up, and the other way, where our normal earnings forecast goes down. We're constantly evaluating our normal earnings forecast and our investment thesis. And when we get new data points, we're evaluating how that might change the long-term earnings power of the company. If we do think something could potentially impact that, we'll go through another version of our research process and go and flesh out the details that we need to, adjust our normal earnings estimate, and adjust the position size accordingly. So with that, that's kind of an overview of how we think about investing, and it's a process we use across all of our strategies and all of our universes. For our mid-cap focused value product, it's a 30 to 40 stock portfolio with pretty broad sector constraints. You can see here that any sector can be 25%, and the financial sector can be up to 45%. And we can also go fairly concentrated. We can be 5% at cost and 7.5% at market. We buy stocks in the cheapest quintile on valuation, price to normal, and we sell stocks when they reach the midpoint of the universe. Our mid-cap universe we define as ranked 200 to 1,200 by market cap, which today is about $2 billion to $25 billion. Here on this slide, you can see how the portfolio is positioned today. I would call it a couple things here in terms of positioning to give you a sense of where we're seeing opportunity. First and foremost is a large position in financial services. That is dominated by banks, insurance, and investment management firms. Virtually no exposure to REITs, even though that's a large chunk of the mid-cap universe. REITs today, along with other yield plays, continue to be at high valuations. And what you can see here as well is that in utilities, we have a very small exposure, despite REITs and utilities being 25 to 30% of the universe. We're also seeing opportunities in producer durables, where you have economically sensitive and cyclical businesses. The technology exposure here is really driven by what I call old school tech. So the low-cost manufacturers, the established players, distribution, and less of the cloud players and the internet darlings. Consumer discretionary here is going to be a decent amount of advertising and some auto exposure. And then the energy exposure is really related to some E&Ps where we believe they're well positioned with strong balance sheets to weather out a uncertain oil price environment in the near term. I wanted to highlight a couple areas where we're seeing new opportunities and some new additions to the portfolio year to date. Those two areas, one would be within healthcare. If you went back a couple quarters, we wouldn't really have any healthcare exposure in this portfolio. But we started to see healthcare show up in the first quintile really around the end of last year, and so we started doing the work. We got to the point where we could add two new positions to the portfolio, Cardinal and Mylan. So I want to take a minute to talk about both of those briefly to give you a sense of the opportunities we're seeing in there. Cardinal is one of 3 drug distributors, along with AmerisourceBergen and McKesson. This is an oligopoly business and has been for quite some time. And the simplest way to think about it is these are the trucks that bring the pills from the pharmaceutical manufacturing facilities to the 70,000 pharmacies in the United States. What happened with these stocks is a couple of years ago there was a bit of a shortage in the generic manufacturing output, as well as you had drug price inflation that was actually boosting margins to a point where they were kind of above historical levels. Companies, of course, at the time didn't really mention that. When we started to return to a deflationary environment for generics and drug prices, margins came under a bit of pressure. You also saw a bit of competitive behavior between 2 of Cardinal's competitors, AmerisourceBergen and McKesson, where there were some independent pharmacy pricing contracts that were a little tit for tat that happened in the 3rd quarter of last year. You know, net, we think this industry structure is very solid and has been for quite some time. The returns on capital of this business are quite dramatic, in that the fears around falling margins or continued falling margins are over-exaggerated. And so we were pretty excited to get this stock into the portfolio at about 10 times normal earnings, a little over 11 times current, given the characteristics of 30 to 40% returns on capital, growth tied towards increasing prescription drugs, and long-term increasing drug prices. So it's a new name into the portfolio. Mylan, another new name in the healthcare space in the portfolio, is another interesting example. Mylan is probably most known for as the manufacturer of EpiPen, which made front page of the Wall Street Journal for weeks on end under pricing schemes. They got subpoenaed to Congress and had to testify. And if you look back in 2014, EpiPen was 20% of Mylan's profits. The focus became so much on EpiPen that people kind of started to underappreciate, and the stock price started to not reflect the value of Mylan's other business, which is their generic manufacturing business. It is a world-class leading generics business that people look up to and point to as the person to beat operationally. While EpiPen's profits have come down, today you're buying the standalone generic manufacturing business cheap, and you're basically getting any residual value of the EpiPen franchise, which we actually don't put too much value on, for free. So we were excited to add that into the portfolio as well during the first half of the year. A slightly different flavor of new holding in the portfolio is a company, Geldwin. Geldwin is a manufacturer of residential doors and windows. And this is an interesting case where you've really seen the residential door market go through a radical transformation over the past decade following the financial crisis. Essentially, the market is consolidated down to 2 players, Masonite and Geldwin, whereas before it used to be 3 players. It also is vertically integrated during this period. So as a result, over the past couple of years, you've started to see the duopoly exert pricing power. This is a great tailwind to margins, and you've seen that in the margins, but also driving both growth and margins is a normalization of housing starts. Prior to the financial crisis, we were building, housing starts were hovering around 2 million, which created an excess glut. Following the financial crisis, we dropped down to about 500,000 housing starts. And when we did the work, we estimate that a normal level of housing starts should be somewhere in the 1.5 million range. Today, we're somewhere around 1 million. And so as we've progressed up, volumes have increased for both Geldwin and their competitor, Masonite. And that's caused incremental volumes on a fixed cost business and caused margins to go up nicely. We still think there's a ways to go on the volume component and the pricing story here. And so we really were excited to get this name into the portfolio, and I think it's another example of some of the opportunities we're seeing in the marketplace today. Financials represent a decent portion of the portfolio here at 38%. And it's really a combination of banks, insurance companies, and asset managers. One of the interesting things we've seen over the past year is the performance, especially from banks, has been quite strong, as there's been the prospect of rising rates. When you think about a bank in today's environment, the biggest asset they have is actually their deposit franchise. But with low rates, the earnings there has been somewhat muted. I would actually wager that most large deposit franchises aren't making money today on the deposit portion of their business. So obviously rates are a nice tailwind for those businesses, but that's not the only thing going on with the banks. They've also been very focused on self-help portions. So cost rationalization, taking costs out, branch consolidation, the introduction of technology into the branch, and all of these things are starting to come through and offset on the cost line some of the pressures they've seen in a low rate environment. You've also seen a regulatory environment for the banks where capital positions have built up as regulators want the banks to have more and more capital, and we're getting to a point where the regulatory environment is stabilizing and you're starting to see increased capital distributions from the banks. And so we think this combination of rising rates, self-help on the cost side, and return of capital to shareholders continue to make the banks attractive investments despite what you've seen in the stock price performance, meaning they were very cheap before and they remain cheap today. A really interesting segment, particularly in mid-cap, that we're seeing opportunity is this asset manager space. And there's two portions in there I wanted to touch on. One is traditional asset managers. So take a Franklin Templeton. Franklin Templeton is one of the leading asset managers and has been under pressure both cyclically and secularly as a move from active to passive. While some of the move from active to passive we think is probably warranted, we do think there's also real value in active management, and it's been a very difficult environment. And as that stabilizes, we expect Franklin Templeton's asset levels to stabilize with a leading distribution force. One of the other interesting things about Franklin Templeton is that 50% of their market cap today is in cash. So when you back out the cash, it's trading at a single-digit PE ratio. So you're getting to buy a leading asset management franchise with world-class distribution with downside protection, 50% of the market cap being in cash. So we think that's a really interesting opportunity where the market has just gotten so focused on the shift from active to passive that they're missing the underlying assets there. If you shift over to sort of alternative assets and alternative asset managers, another place we're finding opportunities with KKR, Apollo, the private equity firms that have really built these leading franchises. And if you look at a KKR today, they've got the envious position of having capital that's locked up for 10 years. They're charging 2% management fees. They're getting 20% incentive fees. And yet when you look at the valuations of these stocks today, the market seems to only be giving them credit for the 2% management fees and ignoring the 20% incentive fees that they earn. And I think that's because oftentimes it's very difficult to model out when the incentive fees are going to come in, and so you get erratic earnings. But when we look at these franchises, we're very excited to buy captive capital with global franchises where the incentive fees are not priced at all into the stock. And so it's another area within financials where we're finding opportunity.
I apologize for the background noise. We have a question. What is the overall opportunity for value investing today, and where are the valuation spreads in mid-cap?
Sure. So we continue to think that it's a pretty attractive environment for value investing today. And if you look back last year, we saw a pretty dramatic run-up in value and dramatic outperformance. And despite that, I think the opportunity is wide. And let me show you a couple data points just to kind of frame that. And what you're seeing here on the upper left chart in the U.S. is looking at, for the 1,000 largest stocks, so this isn't the mid-cap universe, but it's close, the dispersion between the cheapest quintile and most expensive quintile in price to book. And what you're looking at on this blue line is as the line's higher on the page, that dispersion is wider, and as you come down, it's narrower. The y-axis is done in standard deviations. And so you see the big spike in 1999, that's the internet bubble. You can see the financial crisis in kind of 2008 where spreads got wider, but because valuations across the board were quite low, they didn't get as blown out. And you can see since then, spreads just have been marching wider, wider, and wider, really peaking at over 3 standard deviations last February. And so that pullback you see down to about 2 standard deviations was a driver of the outperformance in the market last year. But we still think this has a long way to go, and that we're still at an extreme from a valuation dispersion standpoint. And so what that means is against the backdrop of a market environment that you can argue that the market's overvalued, fairly valued. Very few people are saying it's undervalued today. but you could have a market pullback or a sideways market and still have dramatic absolute performance from a value strategy. And so when you look at our portfolio and the positioning, the reason why you see these skewed sectoral weights is because we're going to where the opportunity is and where these sectors are really out of favor from a valuation standpoint and a company standpoint.
Okay, well with that, thank you everyone for joining the call today. John and I greatly appreciate your interest in our firm. Please see our contact information on the screen. For further information, you can find us at www.pzena.com.